All right, California bond investors are becoming increasingly skittish as the state's budgetary woes worsen. Paul Brennan manages $12 billion in municipal bonds at Nuveen Asset Management. His firm has a, quote, meaningful exposure to California bonds, and he joins us from Chicago with some of his perspective. And, Paul, I got to say, we were talking a little during the break. Yields are not on the tax-exempt California GOs really as high as you might expect.
No, they're not. They did increase throughout most of June as we were approaching the end of California's fiscal year end, and the realization that a budget may not get passed and the rating agencies were changing their outlooks. But weirdly, we've seen actually a little bit of improvement this week, as I think that's been driven by the issuance of the IOUs, which at least will deal with their short-term potential cash crunch.
What are we going to see as far as the spreads if California doesn't pass a new budget by, say, Monday?
I don't know in the short term we'll see much change in the spreads, because I think right now the state is temporarily out of the liquidity crunch because of the issuance of these IOUs. They were going to run out of money by the end of July, but these IOUs will get them through that period. But I think the longer we go, potentially that could put pressure on yields if the state continues to be stalemated on the budget issue.
Yeah, I mean, as far as I can see it, they did run out of money in July. IOUs, right, are not really legal tender, and a lot of the banks are saying we don't want to take them anymore.
Essentially, I mean, if they didn't issue these IOUs, they definitely would run out of money. This is really a form of forced borrowing. They have forced some vendors and other recipients to take these IOUs in lieu of cash. So it is a way of borrowing to raise cash.
3.2% is what you get on the IOUs. I don't think that's tax exempt. You're better off really buying the bonds.
Well, perhaps, but they are tax exempt, at least for the time being. There is some potential scenarios where they could become taxable if they are not paid back or redeemed over a certain period of time. So there is a risk there that these could become taxable later if the state does not redeem these I think in a period of less than 1 year.
Is there any optimism that in case they don't pass a budget and in case they run into a real crisis with these IOUs, that the federal government will reach out and bail them out? I mean, we've bailed out banks, we've bailed out car makers. Why not go ahead and bail out one of the biggest states?
Well, it's a potential scenario, but again, we think the state does have the resources to pay their debt service at least. The Constitution requires debt service to be the second most priority payment item for the state after education spending. And if you take those two spending requirements, the state does have sufficient resources to pay debt service. The issue, of course, is what are they going to do with some of the lower tier spending requirements? And eventually they are going to have to come up with some budget solution that narrows this $26 billion budget gap that they have.
Are we seeing, or are you seeing other states that look like they're as close to the brink as California?
I don't think we have other states that are experiencing the same liquidity crunch and significant budget gap. Most states in general are obviously experiencing gaps and reduction in revenues and more spending pressures, but I think in California it's much more acute because of somewhat of a dysfunctional political and budgetary process, and the economic contractions really bringing light to that fact.
Bottom line here, is there any concern that the state of California would actually default on its general obligations?
No, I don't see that, at least currently. The state is still A-rated by 2 of the rating agencies, and that really is an indication that there is adequate resources in the long run to pay their debt service, and we're not expecting a disruption in debt service. But that doesn't mean we're going to continue to see rating pressure, and it could still be a very bumpy ride for investors. But I think debt service default is unlikely right now.
Hey, you bring up the ratings agencies. You still see Moody's and S&P rating them single A. Fitch coming out and cutting them down. Is that because Fitch has its finger on the pulse better than Moody's and S&P, not as afraid politically to lower the ratings, or is it sort of a marketing or an attention-grabbing ploy?
It could be, but I think Fitch is just a little more pessimistic about the budgetary gridlock in California and the fact that the state is now having to issue IOUs because they're essentially out of cash. seems, in their mind, to warrant a downgrade to the BBB level. And there's really no other state that's experiencing such an intense cash crunch right now. So I think in their minds, a BBB level seems more warranted.
All right. Hey, Paul, thanks so much for joining us. Paul Brennan there from Nuveen Asset Management.